Right now, millions of Americans are opening their bank apps and finding a smaller paycheck than they expected. And a lot of them don't fully understand why. It's not inflation. It's not a new tax. It's a wage garnishment notice for a student loan most of them thought was frozen, forgotten, or someone else's problem. In the first 3 months of this year alone, 2.6 million more federal student loan borrowers were pushed into default, on top of roughly 1 million who defaulted in the final months of last year. Add that to the more than 5 million already in default before that, and we're approaching a number that should stop you in your tracks. Nearly 1 in 4 student loan borrowers in America may soon be in default. This is part 1 of a full breakdown of what's actually happening, why it happens so fast, and exactly what default really costs you. Let's get into it. To understand why this is happening right now, in 2026, you have to go back to 2020. When the pandemic hit, the federal government froze student loan payments. No interest, no due dates, no consequences. For most borrowers, this was the longest stretch of their adult life, where student debt simply wasn't a monthly reality. That freeze lasted, through extension after extension, all the way until October 2023, over 3.5 years. Here's the problem that freeze quietly created. An entire cohort of borrowers restructured their financial lives around a monthly bill that didn't exist. They took on new expenses, new leases, new credit cards, new car payments, all sized around a budget that assumed student loans were $0 a month. Think about what 3.5 years actually means for a household budget. That's long enough to sign a new apartment lease twice, long enough to finance a car and be halfway through paying it off, long enough for "I don't have a student loan payment" to stop feeling temporary and start feeling like the new normal. When payments were finally required to resume in October 2023, millions of people had to rebuild a bill they'd mentally erased for 3 years, on top of every other financial commitment they'd made in the meantime. Even then, there was a soft landing built in, a 1-year on-ramp period where missed payments wouldn't be reported to credit bureaus or trigger default. On paper, that sounds generous. In practice, it created a false sense of safety. A lot of borrowers understood "you won't be penalized" to mean you don't really have to pay yet, rather than the penalty is just delayed. That on-ramp expired, and that's when the real trouble started. Borrowers who'd missed payments during the on-ramp, thinking there were no consequences, suddenly found those missed payments counting for real. A loan is considered in default once a borrower goes more than 270 days, about 9 months, without a payment. For a huge number of people who'd simply lost track during years of shifting rules, that clock had already run out before they even realized collections were back on the table. That's the mechanical explanation. But there's a second layer worth understanding, because it explains why the average defaulted borrower today is almost 39 years old. Not a fresh graduate, but someone in the middle of their career. A lot of these borrowers were current on their loans before the pandemic pause even began. These aren't people who were always behind. These are people whose lives were financially reorganized by a multi-year freeze, and who never fully recovered their footing once real bills came back. It's a very different story than the stereotype of an irresponsible new grad ignoring their mail. This is, in large part, a policy-created problem landing on people who used to be reliable payers. Let's be precise about what happens once a federal loan crosses into default, because the consequences are more aggressive than most people realize, and more aggressive than what happens with almost any other kind of consumer debt. First, your credit score takes a serious hit. Borrowers who've recently defaulted have seen their credit scores drop by an average of 91 points. That's not a small dent. That's the kind of drop that can knock someone out of good credit territory entirely. A 91-point swing can be the difference between qualifying for a decent apartment and needing a co-signer. It can be the difference between a reasonable interest rate on a car loan and a rate that adds thousands of dollars over the life of that loan. It's the kind of hit that follows you into completely unrelated parts of your financial life. Second, and this is the part most people don't see coming, the federal government doesn't need to sue you to collect. Unlike almost every other type of debt in America, credit cards, medical bills, even most private loans, the Department of Education can bypass the court system entirely through something called the Treasury Offset Program. There's no judge, no hearing, no lawsuit required. Once your loan is in default, the government can intercept your federal tax refund before it ever reaches your bank account. If you're expecting a refund boosted by the Earned Income Tax Credit or the Child Tax Credit, the kind of refund that lower-income families depend on to cover rent or catch up on bills, that money can be redirected straight to your loan balance instead, sometimes without much practical recourse in the moment. Third, wage garnishment. Once you're in default, your employer can be legally ordered to withhold up to 15% of your paycheck and send it directly to the government, without ever taking you to court first. 15% might not sound catastrophic written on a page, but for someone already living paycheck to paycheck, losing 15% of every check is often the exact difference between covering rent and falling behind on it. Run the math on your own take-home pay for a second. 15% of that gone automatically every single pay period, with your employer required by law to comply. And fourth, the one that surprises people the most, this doesn't just apply to young borrowers. As of last year, an estimated 452,000 borrowers over the age of 62 were in default. For those borrowers, the same offset program that intercepts tax refunds can also withhold up to 15% of their Social Security benefits. Some of these are parents who took out loans decades ago to help pay for their kids' education, now facing garnishment of the fixed income they're relying on in retirement. This is one of the more overlooked angles of the entire crisis. It's not just recent borrowers at risk, it's people who took on debt for someone else, a full generation removed from their own college years. Before any of this happens, borrowers are legally required to receive something called a Notice of Intent to Offset, sent to their last known address, giving 65 days warning before collections actually begin. That sounds like a reasonable safeguard, until you consider how many people move, change addresses, or simply have outdated contact information on file with a loan servicer they haven't dealt with in years. Loan servicing has also changed hands repeatedly over the past few years, meaning even someone who's diligent about their mail might have their file sitting with a different company than the one they last interacted with. A lot of people are getting one shot at a warning letter that never actually reaches them. Here's where the story gets confusing, because the government's own timeline has shifted more than once, and a lot of borrowers have mistaken a pause for a permanent fix. In early January of this year, the Department of Education actually began sending out the first wave of wage garnishment notices, about 1,000 borrowers to start, with the number expected to climb every month after that. Then, just over a week later, on January 16th, the department abruptly paused all involuntary collections, wage garnishment, tax refund offsets, all of it, putting the brakes on a system that had just started moving. The official reason given was a transition to a new repayment framework. A new plan called the Repayment Assistance Plan is set to replace the old SAVE plan, launching this coming July. The pause is meant to give borrowers time to explore new repayment or loan rehabilitation options before the harsher collection tools come back online. Here's the critical thing to understand. This pause does not erase your default status. If your loan was in default in January, it is still in default right now. Nothing about the underlying debt has changed. Only the government's use of its most aggressive collection tools has been temporarily suspended. When advisors and tax professionals talk about the biggest misunderstanding they're seeing right now, it's exactly this. People assuming their tax refund is now permanently safe, when in reality, The protection is scheduled to expire around the same time the pause does. Current guidance points to collections resuming as early as this July, when the new repayment plan takes effect. When that happens, borrowers who are still in default will be back at risk, potentially with less warning than the first wave got, since the 65-day notice requirement applies to the initial offset notice, not necessarily every restart of the program. So to recap where things stand, a pandemic-era freeze quietly reorganized millions of household budgets, an on-ramp period expired faster than people realized, and default now comes with consequences that bypass the courts entirely: wage garnishment, tax refund seizure, even Social Security withholding for older borrowers. And the pause we're currently in is temporary, not a fix. If you take one thing from this part, a pause is not the same as being off the hook. If your loan was in default before January, treat this window as extra time to fix it, not as proof that the problem went away. In Part 2, we're getting into something almost nobody is talking about: a hidden tax bomb buried in loan forgiveness itself, exactly how big this crisis really is, and the specific steps to take if any of this applies to you. That's next. No recap, no reintro. Picking up exactly where we left off. There's one more piece of this that almost nobody is talking about, and it could end up being the most expensive surprise of all for a specific group of borrowers. Let's keep going. For years, if your remaining student loan balance was forgiven after making payments on an income-driven plan for 20 or 25 years, that forgiven amount was not taxed as income, thanks to a temporary provision passed during the pandemic era. That tax exemption is expiring. Under new legislation, the tax-free treatment of forgiven student debt under these income-driven plans is going away. Here's what that actually means in dollar terms. Imagine someone who's been diligently making reduced payments for 2 decades, finally reaches forgiveness, and has, say, $40,000 wiped off their balance. Under the old rules, that $40,000 simply disappeared. No tax consequence. Under the new rules, that $40,000 can be treated as taxable income in the year it's forgiven, depending on their tax bracket. That could mean a tax bill of several $1,000s, due all at once, on money they never actually received as cash in hand. It's what financial planners have started calling the tax bomb. And the cruelest part is who it hits hardest. This isn't a penalty for borrowers who ignored their loans. It's a penalty for the borrowers who did everything right, made every payment for 2 straight decades, stayed enrolled in the correct plan, waited patiently for forgiveness, only to find the finish line comes with a bill attached. For borrowers counting down the years to forgiveness, this is genuinely brutal to plan around, because forgiveness dates are often set years in advance, and the tax hit only becomes real the year it actually happens. If you're on an income-driven repayment plan working toward forgiveness, this is worth flagging to a tax professional now, not the year forgiveness actually happens, because by then, there's very little you can do to soften the impact. Even setting aside a modest amount every year leading up to your forgiveness date can turn a financial emergency into a manageable, expected expense. Let's zoom out and look at just how big this actually is, because the scale here is genuinely historic. When the Department of Education signaled earlier this year that it would resume involuntary collections, more than 5 million borrowers were already in default. At the time, the department projected that as many as 4 million additional borrowers could fall into default in the following months, which, if it plays out, would put close to 25% of all federal student loan borrowers in default at once. 1 in 4. That's not a niche problem affecting a small, unlucky group. That is a structural generation-spanning event, touching households at every income level and every stage of life. Independent data backs up how widespread the risk is. Credit Bureau analysis has found that roughly 1 in 5 student loan borrowers overall is currently at risk of default, even among people who haven't crossed that line yet. That's worth sitting with for a second. Even if you're not in default right now, if you're a student loan borrower, There's roughly a 1 in 5 chance you're closer to that line than you think. And remember, the profile of who's affected isn't what most people picture. It's not just recent graduates struggling with their first real bill. The average newly defaulted borrower is closing in on 40 years old. Often someone with a career, a household, possibly kids of their own, who fell behind not from irresponsibility, but from years of shifting rules, an on-ramp period that quietly expired, and a resumption of payments that landed in the middle of an already stretched budget. This is also happening against the backdrop of a broader, uneven economy. Even as headline numbers look stable, a large majority of Americans say they've had to change their day-to-day spending to deal with rising costs. And for nearly a third of those people, those changes are already serious. Skipping medications, missing rent or utility payments, or selling personal belongings just to stay afloat. Student loan default isn't happening in isolation. It's happening to households that are already stretched thin by everything else, which is exactly why a 15% wage garnishment or an intercepted tax refund doesn't just sting. For a lot of families, it's the tipping point. So if any part of this applies to you, here's what actually matters, practically, right now. First, figure out your real status. Don't guess. Log into your account at studentaid.gov and check whether your loans are current, delinquent, or already in default. A huge number of borrowers genuinely don't know which category they're in, because loan servicers have changed hands repeatedly over the past few years, and paperwork has gotten lost in the shuffle. This is step 1, and it takes 15 minutes. Do this before you do anything else on this list, because everything downstream depends on knowing where you actually stand. Second, if you're in default, understand your 2 main paths back to good standing. Loan rehabilitation involves making 9 on-time payments over 10 consecutive months based on an income-driven amount, after which your loan exits default, and critically, the default is removed from your credit history, not just marked as resolved. The trade-off is time. It takes the better part of a year, and during that year, you're still technically in default and still exposed to collection risk if the pause ends before you finish. The faster option is consolidation, which combines your defaulted loan into a new direct consolidation loan, taking as little as 6 to 8 weeks to complete. The trade-off there is that the default stays on your credit report, even though your loan status officially changes. If your credit is already damaged and you're mainly trying to stop garnishment fast, consolidation is usually the quicker move. If you have more time and want the default wiped from your credit history entirely, rehabilitation is worth the wait. Third, update your contact information immediately. Remember, the entire warning system relies on a notice being mailed to your last known address, with a 65-day countdown attached. If your address on file is outdated, you could lose your only warning before collections restart. This takes 5 minutes on studentaid.gov and could be the difference between having 2 months to prepare and having 0. Do this even if you're not currently in default. Servicer records get out of date faster than people expect, especially after a move. Fourth, if you're on an income-driven repayment plan working toward forgiveness, start a conversation with a tax professional now about the expiring tax exemption. Ask specifically what your projected forgiven balance might look like in taxable terms, and whether it makes sense to start setting aside money well before that forgiveness date arrives, rather than being blindsided by a tax bill with no cash reserved to cover it. Even a rough estimate now is infinitely more useful than an exact number the year it's due. Fifth, and this applies even if you're not personally in default. If you have a parent or older family member who co-signed loans decades ago, or who took out loans directly for your education, check in with them. Given that hundreds of thousands of defaulted borrowers are over 62, and Social Security itself can now be garnished, this isn't just a young person's problem. A quiet conversation now could prevent a painful surprise on a fixed income later. And many older borrowers may not even realize the collection's pause is temporary, or that their name is one of the hundreds of thousands already flagged. Here's the honest summary. Millions of Americans spent years living without student loan payments through a once-in-a-generation pause. And the return to normal has been anything but smooth. A temporary pause on aggressive collections right now does not mean the underlying default has disappeared, and a new tax rule is quietly turning loan forgiveness, something that used to be pure relief, into a potential tax bill for people who worked toward it for decades. None of this means panic. It means information, and it means acting now, while there's still a window before collections officially restart. Check your status today. It's the single most useful 5 minutes you can spend after watching this video. If this helped you understand what's actually happening, let me know in the comments if you or someone you know is dealing with this. And subscribe for more breakdowns like this one, cutting through the confusion on the financial stuff that actually affects your life.